All right. Thanks everybody for coming in. Hope you enjoyed your lunch. Thanks for taking the time today to join us for this panel. We've entitled it Living with Whiplash, Trading Through Climate Volatility. Definitely a salient topic for today and for today's world. And I've got two excellent panelists up here to really kind of walk us through that. First I'll make a quick introduction. On the end we have Lee Taylor. He is the founder of Resurety. Resurety is a data analytics powerhouse based in Boston. They provide clean energy market data, risk management software, advisory services, and recently launched a CFTC-approved transactional marketplace for clean power. And their clients include a lot of the world's leading clean energy buyers, their sellers, and an investor network. And also next to me is Daniel Raisman from Aon. He's Managing Director, Global Head of Client Engagement for Client Risk Advisory at Aon. Aon is itself, as I'm sure you all know, global reinsurance provider. It's also a global leader in quantifying, managing, and transferring risk related to natural catastrophe perils, and Daniel's going to be talking a lot about that. He spent a lot of the last decade helping clients quantify and figure out how to transfer risk associated with climate events. So really appreciate you two joining me for the panel. I thought I would you start off with maybe just a word or two about climate volatility, set the scene a little bit for us, and then we'll jump right into it. If you want to get information on the climate volatility, going to the IPCC and the UN and their climate reports is probably the best place to go. The news from there, as we all know, is kind of bleak. There's intensifying extreme weather. There's also a destabilization of natural systems. So you have more, hot weather events. You've got more extreme weather events. You've got, every year being the hottest year on record. So we've got a lot of hottest year on record records. And in the destabilization of national environments, you've got things like the oceans are warming and less able to absorb CO2, and so is our land. And all of that creates in of itself its own volatility, and the IPCC has indicated that there's multiple extreme climate events going on around the world simultaneously and has cascading effects. So all that creates volatility in prices and asset values, and we're going to delve into what all that means and how it can be managed. Lee is an expert in power markets as well as in climate markets, and the power markets themselves is where a lot of climate volatility and price volatility manifests itself. So we're certainly going to get some insights on the impact of climate volatility in power and environmental credit markets from Lee, and what kind of price signals we can read into that. Daniel's focus is different. Daniel's is obviously, Aon is not in the trading market per se, but they're focused on how do you deploy risk capital and enable resilience among assets to ensure growth as we get into a volatile climate. So two very different perspectives, but certainly one that can provide a nice wrap around what volatility is and how to manage it. So aside from quoting the IPCC, which is kind of the thing to do during Climate Week, I wanted to frame up a little bit more kind of what this volatility is, what's causing the volatility, how it's manifesting itself, and in the markets and in the natural environment. So I figured I'd turn to Daniel, who's an expert in understanding these climate and weather events to kind of give us some scope and scale.
Yeah, thanks, Evan.
You got it.
So needless to say, we're living in a volatile time. In terms of event activity that are affecting people and businesses day to day, we estimated that in 2024, there were $368 billion of economic losses globally from natural disasters, $145 billion of insured losses over that same time. And we're off to a quick start in 25. I know now we're approaching the end of the year, but with the California, LA wildfires followed by severe convective storm activities over the past several months, we quickly exceeded the 100 billion threshold in insured losses by the first half of the year. So it's a time where there's sort of a lot of rising losses. What are sort of what can be attributed to climate change is a more difficult question, right? We no doubt have rising temperatures. We see those record-breaking years, year on year. But rising temperatures also mean an atmosphere that can hold more moisture, right? So maybe we have less confidence around how many hurricanes will form. Fingers crossed we're off to a slow start this year. But the events that happen bring more water, right? Like we saw with Helene last year, we saw Harvey, obviously, back, I guess now we're approaching a decade ago. But these events that rapidly intensify, we have wildfire activity, right? Conditions that are conducive to bad catastrophic events. And not to mention people that are moving to high-risk areas and a lot of development in high-risk areas. So Florida and Texas, for example, have both seen nearly a doubling of population since 1990. That well outpaces the national average. And those are areas that are naturally hazard prone, right? We also have areas where there's development. I've been doing a lot of work with data centers and with hyperscale facilities of late. A lot of these facilities being built in high hazard areas, right? A lot of exposure to tornadoes, hail, ideally avoiding seismic areas, but there's incentives, right? There's motivation to build in these areas. There's good tax incentives. There's different factors contributing, but suffice it to say, you've got volatility from an event perspective. You've got more people and things in harm's way, and then of course we have rising replacement costs. So construction costs, notably increase, inflationary measures, et cetera. All of this comes together into rising costs, and really rising costs for insurers who are bearing that risk. And so as we work with our clients as a broker, as Evan mentioned, we're really looking to understand what risks these clients are exposed to. How do we help everyone to better understand the insurance landscape, better understand the physical risks that they're exposed to, and better manage that volatility? So maybe I'll stop the opening arguments.
No, that's really good, and it gives you a good idea in terms of the impacts of climate on the physical world. So Lee, let's talk a little bit about the impact of climate on commodity prices, both power and environmental.
So appreciate you having me today. I think highlighting the conversation around more extreme temperatures has been long discussed around its impact on demand fluctuations. We've had a weather-driven electricity demand sector driven by heating and cooling, but historically we've primarily had a weather-insensitive supply stack. So you're in winter, extreme events notwithstanding, gas plants and coal plants can be turned on when the power is needed. But in almost the vast majority of power markets, you have more and more a percentage of that power coming from intermittent resources, wind and solar in particular. And so you now have a weather-sensitive supply and a weather-sensitive demand that often overlap it in inopportune times. So basically, you tend to have low solar irradiance, low wind speeds during extreme temperature events. Those are also the times when you need the most power production. So what that's meant is that you've had more volatility in electricity prices. I think the most extreme version of that is Winter Storm Uri in Texas. If you were in the power markets in 2021, you probably have some scar tissue left over from some event there. I think you mentioned 150 billion of losses. So in 3 days alone, in the state of Texas alone, the power markets experienced roughly $20 billion of losses just over those 3 days. Power that was usually selling at $25 spent 3.5 days selling at $9,000 a megawatt hour. So depending on whether you were short or long that event, it was either a very good 3 days or an incredibly painful 3 days. And so what we've seen, that was an extreme event of something we've seen playing out in power markets, which is with the rise of renewables, you've got low cost supply most of the time. So power prices in general in the wholesale markets are falling, except for the hours where they don't and they spike. And so you end up getting this right tail, and where that's playing out is you end up having this separation of mean and median effectively. So not to make that too nerdy, but effectively your energy price forecasts, even if you're right on average, are increasingly always wrong. Because if you think about a market where you're forecasting the summer, 9 out of 10 summers, it's going to be worth $25. 1 out of 10 summers is going to be worth $250. This is what sort of Texas is getting used to dealing with, parts of PJM for winter, et cetera. So because of that, if you have calm weather, as we've had for the last 2 seasons in the U.S., everybody is categorically disappointed with power prices if they're a seller, because you never got the price spikes that were built into the expected value. During the one summer or winter that you get a heat wave or a cold snap, the prices blow out, and so you're caught on the wrong side of that if you're a buyer. So the result of that is you end up having these scenarios where everybody's trying to get used to the fact that you're going to be surprised 100% of the time. It's just which side of that equation you're going to be on, and that's, I think, becoming a bit of a new normal for power markets today.
But considering that volatility in the power markets, how are investors kind of responding to that? I mean, it sounds like it's a totally different scenario than what they were investing in maybe originally in those assets, or in their models maybe not quite the same for the new assets they're considering.
So I'd say on the one side, it's a function of how much merchant risk are power market owners, operators willing to take.
Yeah.
So if the view is that, well, if 9 out of 10 summers I'm going to be disappointed, 1 out of 10 I'm going to be ecstatic. There's not a lot of capital out there that loves rolling the dice and just hoping for the best every year. So it's a function of how are you hedging that power. Post-Winter Storm Uri in particular, because of a lot of the challenges that intermittent resources had, you basically can't hedge power and be financeable today unless you have what's called an as-generated contract. So if you're a renewable generator, 5 years ago, you could go and sell power on a fixed quantity basis to a bank, and you would manage the risk that you don't actually produce power during all the hours that you pre-sold. That strategy basically died overnight with Winter Storm Uri, and so you had a shift in hedging strategies. This is where the launch of Clean Trade we just announced was to basically create liquidity in as-generated products where they haven't existed before. I think the other piece of it is you increasingly see groups trying to either physically or financially build more resilient portfolios, whether that's a buyer or a seller. So if you put yourself in the shoes of an energy retailer, so someone who's committed to serving load in a given area, and they're buying renewables to serve that load, because even if you want to buy fixed quantity power, if you think about in 2024, we built 60 gigawatts of wind, solar, and storage in the US. We built 2.5 gigawatts of gas. So regardless of your politics, what is being built, what is being offered as supply is generally intermittent sources. So if you're supplying load with intermittent sources, you are very short volatility. Extreme weather shows up, your prices are going to go up, and your supply is going to go down. That's a problem for you. Increasingly, you see those groups through tolls or through investment trying to get long energy storage, because energy storage is long volatility. And so you see both physically and then financially through heat rate call options, et cetera. Everybody's trying to figure out, all right, well, if I used to just be a solar developer, I used to be a retailer that served load with coal, that doesn't work anymore because of what is on offer. And so I now have to build these portfolios or hedge them or buy insurance against them because your options are limited for that. Just I'll turn the plant on when the power is needed.
And Daniel, I'm assuming the investors we're talking about are the same investors who are clients of Aon, right? So, and they're taking there's the markets and then how that's driving them and how they hedge in the markets. How are they addressing it through the insurance market then?
Yeah, so I mean, we certainly advocate for insurance as a means of sort of proactively preparing for the worst day. We're doing a lot on the due diligence side. So how do we help someone to understand upfront as an investor, what is the inherent risk in the investment that they're about to make, whether that's exposure to, a number of extreme heat days, for example, and how can they actively prepare for that and anticipate what could be downside throughout the duration of that investment. So we look sort of due diligence through the hold period as well as disposition. So how do you think through the risk inherent in a project? On the renewables side, I talked about the activity so far from severe convective storms. That's been a huge challenge, right, for solar farms that are in hail-prone areas that are suffering major losses. And if they can have excess panels on hand, but the need to actually replace a farm that's been completely damaged is really, arduous and burdensome. So we're looking at how do we better quantify the risk to those assets? How do you understand as a prospective investor or a prospective developer, where could I place these that balances exposure to sunlight, but also less exposure to hail, right? And as I mentioned before, that can be challenging, right? There can be incentives and other reasons to build in high hazard areas, but we like to think about how do you manage that risk to the investor, and how do you connect that with the right insurance coverage, if relevant. It could be a parametric product, for example, to sort of prepare from the outset if you see this sort of size of hailstone, or if you see this number of days above a certain threshold of extreme heat, where power might be reduced. Or if you're talking about wind, it could be, when is there not going to be as much wind, or when will there be catastrophic winds that mean shutting down the turbines? So we look to understand that and then help to provide sort of an insurance product or facilitate that transaction to actually protect the asset up front. So you battle with convincing someone to buy insurance at the outset, but with the promise that if the bad day arrives, right? If you're maybe your nine bad years, it's not going to work so well for, right? But that 1 year, that one bad occurrence, how do you better protect those assets?
And it's obviously a question of quantifying that incremental risk, right? And I think that seems like that challenge it's always a moving target, as any risk would be. But particularly now with climate volatility, how are you all seeing, you as well, Lee, like with the clients that you have, them quantifying, or perhaps this is assistance you all provide, quantifying what that incremental climate risk is. It seems like a challenge that, even though it's constantly moving, something that's essential to making those initial investments and then additional risk hedging after that, right?
Yeah, so I'd say in general, and this is back to the one solution is to build portfolios. Not every entity is in a position from their core business to build those portfolios. So are they transacting to hedge that away to somebody who is? An example of that is, so a lot of corporate clean energy buyers make public statements of, we've signed a 15-year power purchase agreement with wind farm X, solar farm Y, in order to achieve our sustainability goals, and it's sort of a loose long-term hedge on energy prices. Those PPAs are, at best, terrible hedges on hour-by-hour energy prices, because almost no corporate buyer actually has exposure to wholesale power prices, and no data center manufacturing facility shuts down every time it's not sunny and not windy. So for a variety of reasons, PPAs are not clean hedges on energy price risk. A lot of those groups historically, in order to claim additionality and have the renewable energy credits they're getting as part of that transaction, are signing these long-term contracts and taking on a lot of the project's revenue risk associated with that power purchase agreement. A year, 2, 3, 4 years into those PPAs, a lot of CFOs are saying, are we really supposed to be the group holding the volatility of hourly power markets in this location? Maybe not. And so we should be, let's hold the long-term PPA, but for the next 5 years, let's hedge out of our exposure. Basically, you're selling the financial settlements of your PPA to somebody who's in the business of bundling those up and adding in storage and heat rate call options, et cetera. So we are starting to see that as those risks are showing up in a lot of the businesses that are not used to holding power market volatility in connection with their sustainability strategy, they're turning around and saying, we did the press release on the 15-year PPA. We're not going to do the press release on the 5-year PPA hedge, but that way, our CFO now knows effectively what those RECs are really going to cost for that next period. So I would say that's the thing we generally see is, as people were surprised at the positive, but still surprised. Power markets in 21, 22, 23, combination of Uri, temperature, war in Ukraine, prices were much higher than most people expected. Yep. If you're a corporate buyer, getting a windfall from your PPA settlements is still not a great thing, because you're not supposed to make a windfall for your sustainability strategy.
Right.
It's better than the opposite, which has been happening more frequently recently. But as people are saying, no matter whatever budget you come to me with every quarter, it's always wrong. And so to the right or to the left, so why are we holding this risk? Let's so think back to the sort of premise of trading out of it. How do you provide the liquidity that lets people keep what they want, the RECs, long-term hedges, and not keep what they don't want, that sort of month-by-month cash flow volatility? So I'd say that's one of the areas we've seen the most impact recently.
Yeah, that makes sense. And I mean, Daniel, a lot of what we're talking about is risk. You're attempting to quantify. I'm assuming there's pretty serious gaps in terms of visibility, into that data and actually how to quantify the risks. And so I'm interested in how you all approach that, considering your business and ensuring those risks.
Yeah. So first and foremost, and maybe connecting into the past topic as well. So when we think about climate risks, right? Risks are not necessarily created equal in terms of extreme heat. A change in 10 more days of extreme heat that exceeds 100 degrees in Minneapolis is quite different from 10 extra days in Phoenix, right? In Phoenix, you've prepared for that. If you're an investor, you're aware of that risk. In Minneapolis, that's a difference in OpEx costs. It's a difference in potential disruptions, quality of life, right? Human impacts as well. So when we look at quantifying risk, I would say we leverage two tools generally. From a bottom-up analysis standpoint, we leverage catastrophe models, which are used by the insurance industry to transact risk day in and day out. Those are probabilistic models that simulate effectively 10,000 or 50,000 views of next year or any given year. And they'll create realistic, physically plausible event tracks. So I take hurricanes as an example. You have hurricanes that track all the way from the Atlantic up along, into the Gulf or up the East Coast, right? You simulate that hundreds of thousands of times, each with a unique event footprint, and understand how much physical damage was there to a given asset or to the portfolio. What is the marginal impact of introducing a new asset, of building a new solar farm, of building a new data center in a given geography, and how does that impact my overall portfolio risk? Those do a great job at saying, what's the risk today? When it comes to what's the risk tomorrow, or tomorrow's a bad example, what's the risk in 2040 or 2050? We need to lean into climate models, right? Which takes sort of a top-down approach of saying, in a globally consistent way, how do we measure sort of changes? And extreme heat's a great example of where this works really well, is understanding how trends in sort of heat could change on a geographic basis and sort of around the globe, but reconciling changes in global systems down to an individual hurricane occurrence or an individual hail swath or an individual tornado swath is much more challenging, right? So we look to combine those methods to say, how can we take the fundamentals of probabilistic modeling and assessing catastrophe risk that could exist, and how do we forward project that to look at occurrences that haven't yet happened, where we don't have distributions, right? The struggle, on the catastrophe modeling side, we're often looking into the past and sort of building distributions off of historical activity. In the climate models, you have the complete opposite challenge, right? You haven't seen what's going to happen next, so you're trying to do your best to understand which direction we could be moving. So we leverage the combination of those two tools and touch on different models, because at the end of the day, these are all models, so they're inherently imperfect, but they're useful. And so we pull them together to really quantify that risk at an asset level, as well as at that portfolio fund, et cetera. And all tied back to a physical location, which can be a challenge as well.
And so are you seeing a shift in investment on a geographic level based on the models and the discussions that you had around the risk premiums that are associated with specific locations?
Absolutely.
Yeah.
So we have clients who we help with site selection.
Yeah.
So it could be at the point, either, if you're a developer, it could be, I'm evaluating these 5 sites, right? Which one is exposed to the least risk? Or what do we know about the prospective insurance costs over the life cycle of this, right? That's where we'll be pulled in from that standpoint. Also, hey, I've got a real estate investment portfolio. I want to know sort of where are the hotspots in the portfolio, right? I'm being quoted an insurance premium every year. I don't understand sort of what's contributing the most to that view.
Yeah.
I feel like I'm paying a disproportionate amount. In some cases, we've had clients, we worked with a bank on their real estate investment portfolio, and they had around 1,000 assets globally. we found that one hotel in Florida contributed 15% to their overall portfolio risk, one hotel out of 1,000. And it was sort of 80% of the risk from 30% of the assets. So you start to drill in and say, well, what are the contributing factors? And maybe the answer is I'm already mitigating that risk effectively, right? Maybe I've hardened the asset. I've actually thought about, buying specific insurance to cover aspects of that, and maybe that's, okay, job well done. But how do we better manage risk? And there's increasingly assets, I won't say uninsurable, because I believe that we can still find insurance solutions. We're constantly innovating to use insurance as a mechanism to bring capital, bring funding in to improve and innovate, really. Because how else do you develop new technology if you can't get capital into the room to play?
Yeah, exactly. Lee, just back to the original question on the visibility and the gaps in information, and all of the modeling and the work that you all do in power and environmental commodity markets. I wonder how you deal with that same challenge. Obviously, Daniel has some climate and risk modeling and whatnot that they use. I'm interested in how you all approach it.
So, it's fairly similar, use historical probabilities and amend them for what could happen in the future, but it's down at the per electrical node per hour at a location. So it just gets, for the power markets, very high temporal and regional granularity because, I'll keep picking on Texas because why not? But if you've got coastal wind farm in Texas, when it gets hot in the center of the state, it gets particularly windy at that. You go 50 kilometers in, and the wind dies during a heat wave.
Right.
So those are two southern Texas wind farms that get totally different financial outcomes depending on weather conditions. And so it's the sort of the granularity that happens at that point, as well as what it is that is going to make that mitigatable, if anything. And I think that the other piece about that is, where the insurance side and the power markets are coming together right now at the moment is, you're right, everything is insurable, but as the insurance cost goes up, you just keep driving the spread between what someone needs to get a project built. Yeah. So capital costs, cost of the equipment, cost of the insurance, relative to what the expected value of the power is going to be, just on sort of a merchant value. And that spread in most places has been growing, a combination of tariffs, insurance, everything. I don't know if you want to toss in political insurance on top of that. So that, I would say that spread, modeling that spread, how big of a gap there is effectively between the marginal cost of building an asset today relative to the marginal value of the power it's generating, is coming up a lot, especially because we were talking about this before the panel. Scope 2 carbon accounting isn't something that gets a lot of discussion in commodity markets, but a lot of times, think about third to a half of the assets that have been built in this country recently on the wind and solar side of things have been driven by voluntary demand of corporate buyers who are doing it for a very specific reason, because they say, by 2030, I'm going to be X% carbon free. The rule book that lets them say that is actively being rewritten, and there's a lot of concern that demand will go away. And if that demand goes away, who's going to fill that gap on the difference between the cost of building a new asset relative to the cost of its operating value? The hyperscalers, et cetera, have been very busily buying, but if that demand goes away, there's a lot of challenges ahead.
Yeah, it's interesting on that carbon accounting side. It's interesting if you're seeing those signals already in the market. Right, the draft rules are out there, and there's plenty of stakeholder discussions happening. But I'm curious to see here if you're hearing already some market signals, you being closer to the market part of it. Yeah.
So no one has quite said, if you pass these rules, I will unequivocally step away. Everybody is generally saying, if you pass these rules, I'll stay in, but almost everybody else will leave. So please don't do that. But maybe just how many people feel like they're familiar with Scope 2 accounting? Okay, and are familiar with how it's being rewritten. Okay, not as wide an audience. So basically today, if you buy a renewable energy credit from a solar project in California, you can effectively offset that against consumption at a manufacturing facility in Virginia. So that electricity has no physical chance of ever making it to Virginia, given where the power markets are. And also the California grid's about 4 times cleaner than the Virginia grid. So you're not actually offsetting the same level of carbon. And so that's been known, but the simplicity of the current system has had a lot of benefit in driving voluntary demand. But basically right now, World Resources Institute and the Greenhouse Gas Protocol are rewriting this rule book, which is effectively the gap accounting for carbon, to say that you really either have to rigorously, demonstrate that you're physically using power that you're buying, or that you're making sure that those two things are at least matched in their carbon intensity. That will have potentially very dramatic impacts. Grids that previously haven't gotten much investment because it's more expensive to build will get more investment. Places where we've been very successful at building renewables historically will get less, because right now we've been optimizing for where is the cheapest rec effectively as a system. This pushes things to where the grid or the environmental impact needs it more or is larger. And so I know there's a lot of folks related to expansive carbon credits, renewable energy credits. That becomes a vessel for much more granular information, whether it's the hour of the day and the location, or how much carbon is sort of the carbon intensity of the grid in that hour, that location. Yeah. I think that will be the new norm. I think the final rules are due out of the final draft in the next week or two. So a lot of carbon nerds are eagerly watching their inboxes. But it's a $100 billion investment industry behind those credits. So it's a pretty big change that's potentially coming. Yeah, you can count us among those nerds who are watching that stuff closely, obviously, and we have a number of clients who are as well. And it's interesting to, the discussions have switched from talking about long-term, spot rec sales, long-term rec sales, green PPAs, and now you're like you said, you're seeing a pause in terms of, because those are significant long-term investments for many of these corporates. And as you mentioned, the power market is always going to shift underneath those PPAs, right? So you could do it, pay the money, and move on, or you can manage the risk, which, like you said, we've seen clients as well doing that same thing. But the impact that it's had on the market, as people try to understand the rules, such as they are, right, voluntary rules, but even still, the market needs some type of signal. It's been, we've seen that as well. Yeah. So Daniel, maybe we could switch back to kind of the kind of, on the policy side, not to get into the specific policies, but I'm curious, we talked about the modeling and all the data that you do. Are you managing policy risk? Are you quantifying it in some way? Does that factor into the models that you have? I mean, obviously there's been a lot of shifting around the United States in particular.
Yeah, I mean, we're certainly looking, I don't work specifically on sort of the political risk space. Yeah. But in terms of, managing, I think the availability of data is really critical. And that's something that we've had sort of a challenge with, and sort of managing what's the reality if there's not sort of the same availability of data that underpins, financial markets, insurance markets. Sort of how do you deal with that sort of reality that there could be a different outcome and sort of different availability of data. But I think, there's an opportunity also in that, right, for private sector to step in and more players to come to the table. I think it's already, a super competitive space of climate analytics providers. Yeah. And people coming to sort of hold the torch and say, I'm here producing this data. Can people use it? But I think it's a challenging one. And yeah, I mean, from an insurance perspective, obviously tariffs, other impacts, all of this goes into costing and assessing, what could tomorrow look like and what might I need to consider as risk that could be, adding to that volatility.
And does it also, are you looking at the policy environment too for, policies that are made today and the impact they're going to have 5, 10, 20 years out into the future? Or is that difficult to assess and doesn't necessarily?
Absolutely, in terms of understanding sort of carbon emissions trajectories and how that could impact sort of physical risk in particular from my perspective, as well as transition risks. Yeah. But yeah, less for me on the political side, more on sort of what are the implications on sort of human well-being and physical assets. Yeah, that makes a lot of sense. So getting back, Lee, you had mentioned it, the kind of the interplay between the markets and insurance, just kind of while you bring two different perspectives here, there is kind of an interplay between the two, and Lee provided his perspective a little bit. I'm interested, Daniel, in your perspective on it in terms of how you see the interplay between the two. Sorry, can you repeat that?
Yeah, just the interplay between the power markets or the underlying commodity markets and the insurance market.
Yeah.
Just your views in terms of how they interact.
I mean, I think I saw a lot of similarities, and as we were talking about before this panel, I think there's quite a bit of overlap. I said sort of I work in sort of the physical risk space, but the reality is that we're constantly working on hedging and mitigating downside associated with any new investment, as I mentioned, whether that's sort of technology performance insurance. So how do you mitigate against an underperforming asset, right? How do you incentivize investment into new technology? But I think there's a lot of overlaps between the two.
Yeah, great. Thanks, everybody. So I thought we'd open up to the audience and see if we had any questions for the panelists up here. Yeah, sure.
Christopher Castro, National Center for Atmospheric Research. This necessarily all relies on weather and climate information, whether that's historical or forecast. So what kind of information do you use right now in that space, and how would you like it to get better? So, I come from a premier research institution where we generate this data, we observe it. So tell us what you need.
I'll go first, or me too?
Go first.
We rely heavily on a lot of reanalysis data sets, the high granularity, so what's happening, everything from, if you're talking about a wind project, you're focused on what's happening 60, 80, 120 meters off the ground from a wind speed perspective and how that matches up with temperature, to trying to figure out which parts of the country are going to be producing power during a heat wave and which aren't, the impact that has on that asset, but more importantly, sort of the broader grid. So that visibility to the weather data at a high resolution, high confidence, most of that sort of real time to day ahead. I think that if you can tell me where wind speeds and irradiance patterns are going to change with high level of confidence a decade from now, I know a lot of people who would use that. I think the uncertainty bounds that far out get so broad. But I would say it's the really high resolution, real time and historical. A lot of that also gets brought into some of the parametric cover that he's been talking about. A lot of these contracts for power, you're saying, well, I can't make you as a solar project block clouds from happening, like they're going to happen, but I can force you to operate when it's sunny. And so how do you separate, weather-driven risks from operational exposures is a big part of contracting. Confidence in the data behind it that lets us split those apart, I would say, is the highest piece of that. I would say the other part is just consistency. Like we relied on some NOAA data that disappeared for a while. It's back now, but knowing that it'll be there is important, because if it's built into a contract, having the data source disappear due to politics is challenging.
And I would say, I'll take it, certainly day-to-day risk, I think less about, right, in terms of, tracking hourly forecasts and that kind of thing. But if you do talk about sort of insurance as a concept, and if we look at different types of triggers for insurance policies, you sort of have indemnity covers where an insurer, insurance companies have claims teams. They can tell you to the dollar how much money they lost from, Hurricane Milton. They have that ability to quantify risk after the fact. So you have high confidence if you're sort of taking on that risk that how they performed. When it comes to things like parametrics, where we're saying, what's the depth of flooding at a given site that's insured, you have a lot of basis risk in terms of you can forecast up front and say, there's this probability of occurrence, I could see this size of hailstone or this number of days of extreme heat. But sort of how does that connect to the impacts becomes further and further. Like, how did that correlate to the actual loss that a business suffered? Because maybe the extra days of heat had very little impact, right? But maybe they had a catastrophic impact. So I think understanding the downtime. So if we talk about data that's useful, certainly better reporting. There's a lot of firms out there, as well as academic institutions, better quantifying flood from satellite imagery, being able to better understand exactly what depth of flooding occurred and sort of how much damage occurred. We do a lot in the wildfire space as well, and flood with a company called ISI. They help to sort of understand real-time depths or burn footprints, like after the California fires. And then, back to the catastrophe models that insurers use, right? Those take years to develop. So they're really sort of robust models that don't get updated, more than every couple of years, basically, because of the computational requirements. But those underpin sort of all insurance transactions day in and day out. And so they're important, and we rely on a lot of data from, the National Hurricane Center, the reanalysis data, from HERDAT. So different data sources. USGS is another one, right? USGS, the availability of global earthquake and seismic data enables parametric insurance for earthquake, which is a lot harder to come by on the flood side, right? Harder to do at scale because that confidence around how much ground shaking was there at a point that can be read is a lot different than someone holding up an anemometer, measuring wind speeds from their balcony.
Thanks for the question. Any other questions? So Lee, I had one. You talked about, emissions pricing down to that, or emissions levels down to like the hourly level, right? And I see that as you do is kind of the direction where it's going. I think it's more efficient for the companies that have taken on the voluntary commitments, right? Because they could be knowing even more to, and also to a more finite level what their actual emissions levels are. Perhaps it's less than what they thought it was going to be. Perhaps it's more. They can manage that risk. Also for the dispatch, especially if they have batteries, when to dispatch. So getting back to this data question, the current administration's proposal to eliminate the collection of CO2 data, how's that going to impact the push towards hourly recs and understanding your emissions profile on an hourly basis?
I don't actually think it will impact it that much because it wasn't up to this point really the federal government that was publishing a lot of that. So if you think about the rec registries that are starting to publish this, those are either independent or connected with the independent system operators. So PJM has their version, ERCOT in Texas has their version if we're talking in the US. You've got each of those groups are are increasingly publishing data. So PJM was the first in the US, followed by New York. MISO is quickly following. So those are all I would say at a state, regional level, starting to make it available. And then you've got a company like ours that publish it on they sell the data, and then you've got NGOs that are making it available. And increasingly those are being published as waterfalls of sorts. So if the government makes it available, use it. If it doesn't, use this as the backup. If that's not available, use this as the backup. So it's really set up to be pretty resilient from that perspective. So it's not dependent on a single source of data. The bipartisan infrastructure bill required that the EIA publish data everywhere in the country. They required that and then didn't fund it, so it didn't happen.
Right.
So I think everybody's waiting for that to happen. I don't think there's a whole lot of people holding their breath during the current administration that will be a priority. But those revisions of what's available are going forward as is. And it's worth pointing out, almost all those data sets are required globally. And so I think, gap accounting is US, but scope 2 accounting is everywhere, right? So if you're an international company, you're using this in every country on the planet, and so it's really the movement of an individual government is intended not to have that affect that. So I would say at this point, the availability of the data is really not the challenge. It's just what ends up being required and adopted is ultimately what's going to drive it.
Yeah. So in the couple minutes that we have left, I'm curious, just kind of looking forward, going out past 2030, a lot of discussion today and a lot of, around, up to 2030, very difficult to look out there, but I'm interested, hopefully we're all interested in kind of understanding how we can understand volatility differently, like going out further, and what kind of new and innovative products are people working on now, like be they your clients or other folks, traders in the industry, whoever, working on now that are going to be more important for resiliency or just for managing climate volatility risks in the future. So going out past 2030. Dan, if you want to.
Yeah, sure. First. I mean, I think we we really need to crack the nut around incentives and how do you make sort of resilience good business? Because I think irrespective of, political environment, it needs to make sense, right, to invest in something that's resilient or a new product. I think in terms of how the risk could evolve, we've constantly, at least in my world, we've constantly had these milestones that have sort of shocked the industry and the insurance industry in particular. Hurricane Andrew in 1992 caused 11 insolvencies in the insurance markets in Florida, for example. 9/11 was a shock for the casualty market. And then we had big years, 2011 with the Tohoku earthquake, severe convective storm activity, wildfires in 2017, 18. So trying to understand what could be that next sort of defining event is, I think, inherently a challenge. We can use tools to help to understand what those, what does that tail risk look like, right? If heaven forbid that event does happen, what does that mean? But I think, we need to get incentives on sort of better building practices, as well as managing, evolving risks. So whether that's battery storage or new evolving, renewable technologies, how do we make those projects sort of bankable, insurable, and better manage that risk throughout it? But I think there's exciting times ahead, but needless to say, a lot of uncertainty and challenges as well.
Yeah. Lee, what are your thoughts?
Yeah, for better or worse, I don't think there's any technology breakthroughs that are needed. I think we have most of the tools we need. It's a question of utilization. You think about the energy system in the U.S. for the last 10 years has basically been we've been retiring coal plants and building wind and solar. That's because load hasn't been growing. It is now. If you stay on that path and that path alone, you're going to end up in a much more volatile power market. But transmission, storage, there are gas peakers. Those are all things that can run the other way. None of those are new technologies. Getting things built in a difficult time. So I would say on that front, we have the technology. It's just using it. And I think when you get back to the sort of the carbon component of these things, back to the question you had earlier, there isn't a sort of novel data source needed. A lot of this information exists today. S&P publishes the carbon intensity of RECs in almost every market in the U.S. today. Yep. It's a question of how are brokers using that to explain to one buyer versus why that REC is more valuable or not. The education component as to what that means from a either voluntary or regulatory market. So I think happily the tools are there, which is solves part of the problem. How well we use them between now and 2030 and beyond will be the big question.
Yeah, great. Thanks. So a great discussion. We started off with a little bit, got a little bleak there talking about some of the trends, but then I think a little bit of ended up through the discussion. I think really identifying what people can do to manage that risk, to understand it and to manage it, which is really kind of the challenge and a good focus for the discussion. So really appreciate both of your time. So please join me in thanking both Lee and Daniel for their time and insights. Thanks, guys.
Thanks.